I would suggest that people have at least 5% of their net worth in physical gold. And I would suggest that they hope it goes down in price. Over 100,000 portfolios in 10 years of grading portfolios. And while I realize that $100,000 is a fairly small set of the investing public, I do note that when those people, some of those people get bitten by the gold bug, and I suspect a high proportion of them are your listeners, that they tend to go overboard. Your physical gold and silver in system available for good delivery is that very often if you're engaged in midnight gardening, which is to say if you hold the gold and silver yourself in your backyard and you want to take advantage of price movements, short-term price movements, you need to reintroduce that gold or silver into the system.
In today's episode, financial expert Rick Rule highlights the importance of owning gold as a hedge against economic instability. He explains that his motivation for holding gold isn't tied to modest price increases, like gold reaching $3,000 per ounce. Instead, he owns it as a safeguard against catastrophic economic scenarios, where gold could skyrocket to $9,000 or $10,000. This perspective stems from the U.S. government's staggering fiscal imbalance, with over $120 trillion in liabilities and annual obligations that far exceed federal income. Gold, according to Rick, acts as insurance during such crises, preserving wealth when other assets may falter. Rick also sheds light on the unique dynamics between gold and silver. While gold tends to move first during market rallies, silver often outpaces it in terms of speed and magnitude. This makes silver a more speculative asset, appealing to those willing to embrace its volatility. Rick emphasizes silver's undervaluation, pointing out how affordable it is compared to everyday items like a $5 Diet Coke. For investors, silver's sharp rallies can offer significant opportunities, but it requires a systematic approach to capitalize on its fluctuations effectively. For those considering precious metals in their portfolio, Rick warns against over-allocating to gold and silver. He suggests that a well-balanced portfolio should include only about 5% in physical gold, enough to serve as effective insurance. Rick believes that many investors get bitten by the gold bug and allocate too much to precious metals, often at the expense of diversification. He stresses that while gold has historically provided strong returns during inflationary periods, it's crucial to maintain a measured approach to avoid being overly exposed. Like, subscribe, and turn on notifications so you don't miss our daily recaps. If you want to take control of your financial future, get your copy of the Stacker's Handbook at goldsilverstacks.com. While you secure your wealth, safeguard your online privacy with NordVPN, protecting you from government surveillance and prying eyes, and manage your passwords easily with NordPass. Sign up now and get 3 free months. Let's dive back into the episode.
I would suggest that people have at least 5% of their net worth in physical gold. And I would suggest that they hope it goes down in price. The set of circumstances that causes your gold to go up rapidly in price, which I think we're likely to see, are invariably fairly unpleasant. But certainly if silver is cheap, gold is cheap too. Gold generally moves before silver does, although silver, when it moves, generally moves further and faster. If the question goes to holding physical commodities as opposed to holding equities around physical commodities, the most convenient to hold and store are gold, silver, and platinum and palladium. About very soon. And you know what? $3,000 isn't a number that excites me at all. I wouldn't own as much gold as I own if I thought it was going to go from $2,700 to $3,000. I own it because several times in my life, it's gone up 5-fold or 6-fold or 7-fold. I own it because the net on-balance sheet and off-balance sheet obligations of the U.S. government exceed $120 trillion. And those obligations, both on and off balance sheet, annually exceed the gross income of the federal government before expenditure. That's why I own gold. I don't own it because I hope it's going to go to 3,000. I own it because I'm afraid it's going to go to 9,000 or 10,000. Many, many, many investors are. It seems that when investors get bitten by the gold bug, they often go whole hog. In my life, when gold has moved, the moves have been dramatic. And if you think of it as I do, as insurance, a fairly small premium goes a long way. If, as an example, you had gold at the beginning of the decade of the 70s, understanding the type of inflation that we would experience in the 1970s, when the gold price moved 30-fold, had you had 10% of your portfolio in gold, you would have enjoyed a triple over that decade on your total portfolio. If you had gone through a much more modest bull market, like the period 2000 to 2010, where the gold price went from $250 an ounce to $1,750 or $1,800, which is to say a sevenfold increase. A fairly small proportion of your net worth in gold would shield most of the rest of your portfolio from the harmful impacts of the deterioration in the purchasing power of the U.S. dollar. Many, many, many people overinsure. Many, many, many people have too much of their assets in physical precious metals or more riskily, in penny stocks associated with gold and silver.
In today's news recap, gold in holding pattern as markets await U.S. data. Gold prices slipped in thin trade on Monday as markets awaited next week's U.S. economic data and the potential impact of President-elect Donald Trump's return to office on the Federal Reserve's 2025 outlook. Spot gold was down today to $2,618.99 per ounce. Quiet day with lower liquidity across all asset classes, likely due to the holiday season. UBS analyst Giovanni Staunovo said, adding that market participants will track upcoming U.S. economic data to see if the economy is slowing, which would allow the Fed to keep cutting interest rates. Fed Chair Jerome Powell said earlier this month that U.S. central bank officials are going to be cautious about further cuts after a quarter-point rate reduction in December, in line with expectations. For insights into the health of the world's economy, traders await next week's U.S. job openings data, the employment report, the FOMC meeting minutes, and the U.S. employment report. We still see the same factors in place which supported gold in 2024, ongoing central bank purchases with a desire to diversify their reserves and ongoing U.S. rate cuts supporting investment demand. Stanovo said, gold has gained around 27% so far this year. It hit an all-time high of $2,790.15 on October 31st. Markets expect significant U.S. policy shifts in 2025, including potential tariffs, deregulation, and tax changes after Trump returns to the White House in January. Now we'll show you more clips of the latest interview, but first smash the subscribe button and check our pinned comment for some massive offers on NordVPN. If you're a serious stacker, this is a perfect fit for you. For less than $4 per month, you can protect your online activity from prying eyes with the most reliable VPN on the market. And believe me, the only thing you'll regret is that you didn't get it 6 months ago. Let's get back into the episode.
I need to begin my answer by saying I don't know, but I'd like to discuss it. The gold and silver price is nominally, at least, as is suggested, set by the LBMA and the COMEX. It's important to note that most days, the futures market in precious metals trades over 100 times the amount of gold and silver available for physical delivery. To the extent that increasing amounts of physical gold in particular are removed from access to COMEX, you set up a circumstance where perhaps ultimately the tail stops wagging the dog. I'm not saying for sure that's going to occur, But I think it's a very interesting circumstance. And it's interesting to note, too, that when that happens, many people who suggest the inevitability of, or pardon me, the inability of that to become a problem, forget the fact that in order to settle COMEX or LBMA obligations, the physical gold and silver has to be good delivery, which is to say all the scrap gold and silver, all the gold and silver outside the system, all the gold and silver held by the Indian peasantry, can't automatically be used to fulfill those obligations. It needs to be often re-refined, re-assayed, and entered into good delivery. So the circumstance where the continued warehousing of gold by foreign central banks begins to disrupt the availability for good delivery in a market where 100 times the amount held for good delivery trades every day becomes an increasing challenge. I would tell people, too, that one of the reasons why you should hold your physical gold and silver in system available for good delivery is that very often if you're engaged in midnight gardening, which is to say if you hold the gold and silver yourself in your backyard and you want to take advantage of price movements, short-term price movements, you need to reintroduce that gold or silver into the system. I'm not suggesting that there aren't other reasons to have physical gold and silver in your possession as opposed to in system. But if you are using it as investment liquidity, it's important that you have some in system where it actually is liquidity.
What do you think? Do you agree with Rick Rule's prediction that silver is set to outperform gold, but only for those patient enough to wait? Is he right that most market commentators are just spouting nonsense and misleading investors with unrealistic hype? Let us know your thoughts in the comments below. Do you side with Rick's no-nonsense approach, or do you think he's being too harsh? We'd love to hear where you stand. Now check this video right here because it's a perfect fit for you. And I'll see you on the other side.